Hello and welcome back to the channel. What you're going to see here today is a collection of videos I made for the members of our community where I give our members the basics of how to make a difficult financial decision between two great options. If I were in the shoes of someone DIYing my own investing and finances, here is the basics of how I would model out that decision. Now, this was done in two separate videos, which I'm clipping together. You might see a background change and an outfit change, but if you can get over that, I think there's a lot of value to be found here. Thank you so much for watching, and let's get to it. Let's address a problem that we all go through. How do we make smart financial decisions when we have multiple good options? Buying cash versus leasing versus finance a car. Like, we all understand that one. Like, a lot of us have been in that dilemma. Do I pay cash for something used? Do I buy something new? Do I lease something? That's a big question. How do we find out which one of those is mathematically the best? Using spare cash to invest in the stock market versus buy a rental property, which I've always wanted to do, or my friend wants to open a business and the idea sounds really good. Most times those fail. But anyways, let's say they all look equally good. How would we decide what's the best use of our money? And honestly, just about any situation where different options have different financial consequences in the future. So now the solution to this problem, which we're all going to have, is a multi-stage method that we're going to cover over the next few weeks as I post these videos to the community, okay? We're going to build from the ground up, from first principles. For a lot of you, this is going to be like, wow, what a great concept. This is so useful. So what might be the solution? Well, let's start with what we know already. We know the following things already, hopefully. Investing money now prudently creates more money in the future. It's pretty basic, right? And the reason I put prudently in there is because if you just invest it all in like crypto or like meme stocks, it might not actually generally create more money in the future. But generally speaking, investing prudently creates more money in the future. Because of that, money today is worth more money in the future. Does that make sense? Let's really grapple with that. If you had the choice of having $10,000 today or $10,000 in a year from now, you'd rather have the $10,000 now because it's the same amount of money. Inflation is eating away at the future $10,000. It'll cost more to buy milk and eggs in the future. So $10,000 now is worth more than $10,000 in the future. And also, you could have taken that $10,000 now and invested it so that it would be worth more in the future. And so we need to understand this concept that because investing now prudently creates more in the future, money is worth more today than the same amount of money would be in the future. Got it? Beautiful. How do we define what money is worth today? Okay, that's an interesting one. So let's say we have a decision like a rental property or a friend's business or using spare cash to invest. We think, okay, the projection is we're going to have this much in the future based on that rental property or that business. What is that worth to me now? Because then I can find out what the present value, what we need to take all these decisions and find out which one is the right one for me to make today, right? So we have to account for some time value here. How do we define what money is worth today? That's going to be the little lesson we're going to learn today. So what we do to define the amount of money today is this really cool process we have in finance called discounting. When institutional investors who work on Wall Street try to value what a stock is worth to see if it's a good buy or not, they're oftentimes using a process called discounting. And so discounting means trying to find some future value that we expect in the future. What is that worth today? We're going to discount that future amount of money to find what it's worth today. The primary thing we're going to need in order to learn how to discount is we're going to need this really important variable called a discount rate. And so what should your discount rate be? It should be the opportunity cost of not investing. So if we have $10,000 in the future versus $10,000 in a day, let's say based on your investment preferences, maybe you invest in a way that's like pretty aggressive, maybe 7 or 8 out of 10 aggressive, and maybe we're going to assume you can earn a rate of 8% on your money over the course of time. So that discount rate is like the assumed rate we need to get to make an investment worthwhile, or the opportunity cost of investing if we got money in the future instead of today. That's what this is. We need to find the opportunity cost of not investing money. Let's assume that is 8%. Let's just take all this information and apply it to something we kind of already know, right? If we have at year zero today, $10,000, what's the future value of that in 1, 2, 3, or 4 years? Well, the future value at point zero is zero because there is no future in the present, right? The future only happens 1 year out. So what we would do is we would take this 10,000 and we'd multiply it by 8%. So now we're going to end up with 10,800. So the future value of 10,000 is 10,800. Well, what would it be in 2 years? Well, we take this amount, and if we reinvest all the proceeds, now our future value in 2 years is 11,664. This should be pretty common for most of you. Just this idea that we're going to compound interest, right? And so the future value of $10,000 in 4 years, if we assume an 8% discount rate, is $13,605. So you could also think of it this way. Bear with me here if you're new to these concepts. This might take a second to grasp. That means the present value of $13,604 in 5 years from now is $10,000. We can reverse back. We can now think backwards. If you were to say, okay, this business that I'm looking to invest in, or this rental property, is probably, I don't know any of this yet. I'm blind to all of this. I'm blind to all of this data here. What is $13,605 worth today? Well, what we need to do is we need to discount it back, find out what that would be worth today. And what we end up finding is that the present value of $13,605 is $10,000. So we're seeing how time and money interact with each other, which is a really important concept if we're trying to determine what decisions are right over time. We have to integrate time into our decision making. Now, here's where we're going to learn a new concept today. And some of you, I would say less people probably know about this one. How do we determine the present value of money that only arrives in the future? So now here's how we would work this. If we know that some rental property or some business we're going to invest in or some sort of financial decision is going to create $20,000 in the future, what is that worth to us today? Well, if we assume this 8% discount rate, what we would do is we take that 20,000 and we divide it by 8%. Okay, so if we divide this one by 8% again, we're gonna get closer and closer to the present. And so what we end up finding, $20,000 in the future in 4 years from now is actually worth the equivalent of us having 14,700 today. So here's a funny thing. What if I put 14,700 in here? you're going to see that we get pretty much exactly 20,000. And if I had added that extra little 60 cents on there, you would see it's probably exactly 20,000. This is the whole idea, this concept that time and money interact with each other. Okay. And so where does this, like, what's the whole point? Where does this get us? Well, in order to determine which financial decisions make the most sense, we need to first understand the idea of how money and time interact with one another. Hopefully we're catching on. And so this is the prerequisite to where we're really going to discover how to make decisions. And in order to find out how to solve these problems, we're going to need a multi-stage method. And so today we have learned the first stage. And so make sure you understand this. And we're going to have a new video just like this one coming out in a few days, where we're going to help you take this process of future value and present value and to help us make decisions about things that we have going on in our life. When we are making some sort of decision in our financial life, it's not always completely apples to apples. Oh, this one I'm going to put in 10,000 and this one I'm going to put in 10,000. And this one's going to return me 8% and this one's going to return me 8%. A lot of the time, the financial decisions we make have different levels of outflows into that investment and inflows from that investment over different time periods and different amounts of money. And so how are we ever going to decide which one of these is the right option? Well, that's what we're going to learn. So if you haven't watched that first part, go watch that now. But if you have, let's move forward. How do we use this method? We talked last time about how this is kind of the part one. It's a multi-stage method, and we only learned kind of the prerequisites. And so today I want to walk us through the full thing. We're going to complete and finish off this idea. Let's take one like this: investing in a friend's business, or maybe in your own business, versus buying a rental property. All right. So what I quickly went ahead and did was just create two different charts. One is going to monitor the business and one's going to monitor the rental property. We're going to talk about the outflows, the things that we have to put into this business venture versus what we expect to get out. And so making these financial decisions requires that we make a few assumptions. The big one being, what are the outflows and the inflows we can expect from these two different ventures? And so let's say that business you want to invest in, whether it's your own or a friend's, it's going to require a $25,000 lump sum this year. That's going to go out. You're going to have to invest that in the business. And then you're going to need an additional $15,000 next year. And then you might need $5,000 the year after that. We have this weird phasing in of these different investments that you're going to have to make. Let's say this is the scenario just for example, right? And then after that, you're not going to have to put any more money in. It's just going to be zero the whole way on. So this already makes it tricky. How am I going to compare that to just investing $8,000 a year in the stock market? It's tricky, right? Now we have to think about what would the potential inflows be. Well, okay, maybe in this business, you're going to put up $25,000 to buy a piece of machinery or invest in marketing or whatever it might be. And then you're going to invest another 15 and another 5. But this initial 25 isn't actually going to produce revenue. It's just going to kind of get us off the ground. This one is going to tie up some of the loose ends. And then we're going to start producing income in year 3. And so maybe we find that after making the following investments in our business, we can expect to then make 5,000, 10,000, 25,000, and then 25,000 on an ongoing basis. So maybe we, by making that investment, have built our way up to some recurring revenue machine that can produce $25,000 for us on an ongoing basis. But it required a lot of work and it required a lot of input. In the initial phases, we had $0 of inflows. We didn't make any money on this. So now let's take all of that and compare it to a rental property. Let's say we want to buy a rental property that costs $400,000, which means that if we want to put a 20% down payment, we're going to need to have $80,000. So $80,000 is going to go out the door to start. And then what we know is that if we have a house that costs us about $400,000, just by a very simple generalization, we can imagine that half a percentage point is probably the monthly running costs. And so the outflows are also going to be $24,000 per year. And so we put $80,000 up front, and then we have to make payments of $24,000 a year to pay the mortgage, the interest, the taxes, all those sorts of things. Now, the inflows are tricky. But let's start simply, right? Let's say on this property, we wouldn't want to make this investment if it didn't at least have some cash flow. So if our outflows are $2,000 a month or $24,000 a year, let's say maybe this property we're looking at can cash flow $500 a month, which means that we would have inflows of $30,000 every year thereafter. So what we've done here is something pretty simple. We've just gone ahead and made some estimates, and preferably conservative estimates. When Warren Buffett does calculations of a similar sort, he's always building in a margin of safety, trying to make it more conservative than it really should be. But let's say in this example, you've gone through and you've built out these two conservative projections of what these investments will do. Now, rental properties can be tricky, or any type of modeling you have to do can be tricky, because you have to think of all the different potential outflows and inflows. In our outflows, I included in that calculation things like property taxes, insurance, maintenance, all these different running costs, which I tend to assume is around 0.5% of the total house value. That usually gets you somewhere in the realm of all expenses. But what about all inflows? When we have a rental property, it's not just like there's rent coming in. The property also increases in value and our tenants pay the mortgage down, right? And so we have to account for those things too. In this final year, our equity position is going to be very different. And so what did we say we bought it for? We bought it for $400,000. Well, what will $400,000 be worth at the end of 9 compounding periods? From year 1 to 10. Well, what we do to find that, if you're not familiar already, is we multiply 400,000 times 1 plus the rate. Let's say the inflation rate is 2%. It's going to grow with inflation over time to the power of the number of years. And so what we find is that this house is going to be worth 470 something thousand instead of 400. And so now we have to account for the equity gain in our final year if this is a property that we want to sell. Now, this gets tricky because in order to find out what our mortgage balance will be, we have to do a future value calculation, which is going to require things like the rate, the number of periods, or the number of compounding periods, the number of periods. We're also going to have to know the payment amount, and we're going to have to know the present value. So let's walk through each of these. We know that the rate on the mortgage, let's call it 4%. The rate on the mortgage is around 4%. The number of periods is 9 years. And if you wanted to make this monthly, but let's make it not monthly. Let's make it the big number. 9 years. Payment amount. Well, if you've gone through some of the modules, you know that the mortgage payment on a house in today's environment is usually somewhere around a 40th of a percent. So 0.004. So the mortgage payment on this house is probably about $1,600. And the present value. The present value is what is this mortgage starting at? So 400,000 minus 80,000, we're going to take 320,000. So now the mortgage amount at the end of 9 years is going to be equal to the rate of interest. And then we put in the number of periods. This is just an Excel sheet calculation. And then we are going to take the number of payments times 12, because that's the monthly payment I find out. And we're going to do minus negative 12 because we're putting 1,600 a month in. We're putting 1,600 a month away. And then the present value is going to be equal to 320,000. So what is our mortgage going to be worth? Well, our mortgage is going to be worth 252,000. Interesting. So now we have a house that was worth 478 and we only owe 252. And so I'm just going to go over here and make this really ugly. We're going to take this and we're going to subtract this. Or we're going to add it because it's negative. And so now we know our equity in this property, 470 minus 252, is 225,000. And so if we were to sell, we would get 225,000. And if we were to sell, we also wouldn't get the rental income for the year. So let's go 225,000. Just make it pretty simple. Okay. That was a lot of work. And some of you might be thinking, wow, that's way over my head. This is an example that I picked that might have been too difficult because we had to actually find out the inflows on a rental property, which is trickier than maybe modeling out other scenarios. However, if you're still with me, or if you're not still with me, let's move on to the final step where I'm actually going to show you what the whole point is here. So we have two empty columns. We have the present value of inflows and the present value of outflows. This multi-stage process is one where we're trying to determine the net present value of a decision. Well, remember last time we had these discount rates that we used to determine the time value of money? Last time we used a discount rate of 8%. Maybe let's continue with that. So what do we do here? We take this number, and what's its present value? Well, it's in the first year, so time hasn't impacted it yet. It's at the start, so it's just going to be equal to 25,000. Well, what's the present value of 15,000 in a year from now? Well, it's going to be equal to 15,000 divided by our rate, 1.08, to the power of the number of compounding periods, and we've had one compounding period. So there you go. And now if I drag this down, it's going to give us the present value of all these different things. So 5,000 in 3 years is only worth 4,286 today. Great, let's do the same thing over here. Well, we know these are all going to be 0. But what if we take this one, 5,000, divided by 1.08 to the power of how many years? To the power of 3 compounding periods, because it took us 1, 2, 3. Great, now we drag this all down, and now we get something really interesting. We have a chart of the present value today of all the future outflows we're going to have to make towards this investment. And we have the present value today of all the future inflows that are going to come to us. And so if we sum these all up, what we find is the total value today of future money going in and out, what that's worth to us today. And the beauty of this whole thing, and this is where this multi-stage process kind of comes to a close, we can find the net present value, which is what is the total amount that comes in versus what is the total amount that goes out. In present value terms, today, this investment is going to make me $41,512 wealthier today. Great. Now, we also want to find out something else called the internal rate of return. Rates of return are easy when you put $10,000 in once and it earns 8% rate of return, and then you get some amount 20 or 30 years later. It's easy to find out that that's 8% because it's growing by 8%. But in this situation, we have different outflows in different years and different inflows in different years. How the heck are we going to find out what the real, true, effective rate of return is for us, given all those inflows and outflows? So in order to define that, we are going to take the present value of all the future cash flows divided by the present value of all the future outflows, and we're going to get a number that looks like 1.96. And from there, I'll attach these formulas below to help you remember them, but they're just things that are in my memory by now. We take this to the power of 1 divided by the number of compounding periods, and we're going to get a number like 1.07. From that, we subtract 1%. Here is our internal rate of return on this investment. 7.77%, assuming an 8% discount rate, okay? So what you could really gather from this is that this opportunity of putting in 25, 15, and 5 and then getting these outflows is worth 7.77% more than just investing in the stock market. Cool. Got it. Great. Well, how about this whole idea of our rental? We were trying to compare these two. Should I buy the business or should I buy the rental? I think you're going to see where we're going. We're going to be able to compare the net present value and the IRR to determine which one of these is preferable. We know the present value of that is that. We know the present value of this one is going to equal 24,000 divided by our discount rate to the power of the number of compounding periods. We will drag all those down, and we will then get the sum of our outflows. That's the sum of our outflows. You notice these two numbers, very different, right? Very different. And so that's why it's important to measure net present value and internal rate of return, because we can help assess investment opportunities that require different amounts. Cool. Present value outflows. Well, we know in the first year it's 30,000. Great. So then the present value of this one is equal to the cash flow divided by our discount rate to the power of the number of compounding periods. Great. So that one's going to be worth a little less than next year. We drag this guy down, and then we can find out the sum of these inflows. And so if we go over here, we look at the net present value, we find that we take the massive amount of inflows minus the amount of outflows. What we find is that this investment over here makes us actually more money gross. This investment is going to kick us back more overall lifetime cash, a larger number. But just because it's a larger number doesn't mean it was a better return, because remember, we had to put a lot more into this one. And so what is our IRR? Well, we take these, sum of our future inflows divided by the sum of the future outflows, and we're gonna get a number that looks like a 1 point something. It's 1.36, okay? Now what we do again is we take that to the power of 1 divided by the number of compounding periods, 9. And what we find is, when we subtract 1 to get a percentage number, it is a substantially better investment in this case to invest in that friend's business or your own business than it is to invest in that rental property, given these assumed series of cash flows, right? Now, if it turns out that our rental goes vacant for a year, now that drops quite a bit. If it turns out that our business isn't as successful as we thought it would be, this one drops quite a bit, right? Whatever numbers you want to put in here. This one drops quite a bit. And so coming up with conservative estimates of what those future inflows and outflows should be can play a large role in the outcome and the decision you make. And so this is why this is a multi-stage process, right? We talked about how this requires a multi-stage method. What I mean by this is we first need to understand the time value of money. Money and time interact with each other in a very important way, and we need to understand that way in order to make financial decisions that have a large period of time involved, okay? So that's important. Next, we need to then be able to project out the types of outflows and inflows that we could expect on different types of financial decisions. That's also not tricky, especially in this case of the rental property where there's multiple different sources of outflows and inflows. Lastly, what we can do is we can sum the present value of future inflows and outflows to determine which of these investments gives us the best cash return, and then we can find out the internal rate of return to determine which of these is the best use of capital, okay? That is a multi-stage process. That is difficult. And I'm going to add one more step, which is what are the subjective and qualitative things I need to be thinking about? In this scenario, I now have to invest in the business and I have to put in more work. In this scenario, I have to just run this rental property, collect checks once a week and make sure the garbage is taken out and the sidewalk is cleared and all those sorts of things. This one requires more work. This one is potentially more risky. It might not work out as expected. This one is a little more stable. And so after you've determined the difference in return, you then have to sift through what are all these subjective pros and cons of each decision. You may find that one of these things is a better investment than the other, but then you have to think about, is it that much better of an investment that I'm giving up X, Y, and Z, my freedom, my weekends, or the risk in this business? And that, my friends, is why we always start with values. Because if you know your values, it's way easier to determine which of these things you should pick. Mathematically, the return on one might be better than the other, but if your values start to push up against that decision, it's going to create some dissonance. So you need to know, what is it that I'm working towards? What is it that I value? What do I want to optimize my life for? And if you can find a decision where the return is better and it aligns with your values better, no brainer. But sometimes you have to make that a subjective decision of, yeah, I'm going to give up some return, but it's more in line with my values. So anyways, this has been a longer video. Hopefully it's been helpful. Hopefully you've come to understand this idea of net present value, internal rate of return, and how we can model out different financial situations in our life. And lastly, why it all comes back to values. So thank you so much for watching this, and hopefully it was helpful.